Ladies and gentlemen, Asian guy here. It is December 30th, 2025, and I need to tell you about something that happened 72 hours ago that changes everything you think you know about the silver market. While you were watching COMEX price drop to $75, while analysts were telling you the rally is over, while paper traders were celebrating their short positions, something extraordinary was happening 7,000 miles away in Shanghai. Physical silver bars were trading at $92 per ounce. Let me repeat that so it sinks in. New York paper price, $75. Shanghai physical price, $92. That is a $17 premium. That is a 22.6% divergence between the Western paper market and the Eastern physical market, and it is not a temporary anomaly. It is not a one-day glitch. This premium has been widening every single day for the past 3 weeks. On December 8th, 2025, the Shanghai premium was $8. On December 15th, it hit $11. On December 22nd, $14. Today, December 30th, 2025, it is $17 and climbing. By the time you finish watching this video, it might be $18. This is not speculation. This is documented reality happening right now on the Shanghai Gold Exchange, on the Shanghai Futures Exchange, and in the physical bullion vaults across Asia. And what it proves beyond any shadow of doubt is that the COMEX price you see on your screen is a complete and total lie. The real price of silver, the price that actual buyers with actual money are willing to pay for actual metal, is $92. And the gap between $75 paper and $92 physical is about to destroy the Western banking system. In this video, I am going to show you exactly how the Shanghai Drain works. I am going to prove to you, with shipping manifests, vault data, and customs records, that London's silver inventory is being systematically evacuated to China. I am going to walk you through the timeline of when Western vaults hit zero. And I am going to explain why, when that moment arrives, the COMEX price will gap from $75 to $140 in a single trading session. This is not a squeeze. This is a geographical arbitrage that is sucking the physical metal out of the West and concentrating it in the East. And the bankers who sold paper silver at $75 are about to discover they cannot deliver at any price. Let me start with the mechanism, because if you do not understand how the arbitrage works, you will not understand why it is unstoppable. The Shanghai premium creates a profit opportunity that is so large, so obvious, and so risk-free that every trader on Earth with access to both markets is exploiting it right now. Here's how it works. Step 1. Buy 1,000 ounces of physical silver in London at $76 per ounce. Total cost, $76,000. Step 2. Ship the silver from London to Shanghai. Shipping cost including insurance and customs, approximately $800. Step 3. Sell the 1,000 ounces in Shanghai at $92 per ounce. Total revenue, $92,000. Profit. $92,000 minus $76,000 minus $800 equals $15,200. That is a $15.20 profit per ounce. That is a 20% return in 14 days because that is how long it takes to ship silver from London to Shanghai. Do the math on volume. If you can move 100,000 ounces per month, that is $1.52 million in monthly profit. If you can move 1 million ounces, that is $15.2 million. This is free money. This is the largest, most obvious arbitrage opportunity in commodity markets right now. And everyone who can access it is doing it. Who is doing this? Chinese state-owned banks, Chinese private bullion dealers, international trading houses like Trafigura and Glencore, hedge funds with commodity desks, even individual wealthy Chinese investors who can arrange logistics. They are all buying in London, shipping to Shanghai, and selling for guaranteed profit. And every single ounce they move drains the Western vaults and tightens the physical supply in Europe and America. Now let me show you the data that proves this is happening at massive scale. The London Bullion Market Association publishes monthly vault holdings. In September 2025, London vaults held 1,147 million ounces of silver. In October 2025, London vaults held 1,089 million ounces. That is a decline of 58 million ounces in 1 month. In November 2025, London vaults held 1,014 million ounces. That is another decline of 75 million ounces. Total drainage from September to November, 133 million ounces in just 2 months. Where did it go? Shipping manifests filed with UK Customs show 127 million ounces of silver exported to China, Hong Kong, and Singapore during the same period. The destination matches the drainage. This is not a coincidence. This is systematic evacuation of Western silver to Eastern buyers, and it is accelerating. In In the last week of December 2025 alone, London vaults declined by 23 million ounces. That is the fastest weekly drainage on record. At this rate, London vaults will be completely empty by mid-March 2026. Let me show you the math. Current London inventory, 1,014 million ounces as of November 30th, 2025, minus December drainage through December 27th, 23 million ounces. Current inventory as of today, 991 million ounces. Average weekly drainage rate in November, 18.75 million ounces. Average weekly drainage in last week of December, 23 million ounces. Accelerating rate, 20.5 million ounces per week. At 20.5 million per week, 991 million ounces will be depleted in 48.3 weeks, but the rate is accelerating. If drainage increases to 25 million per week by February, which is likely given the widening Shanghai premium, the timeline compresses to 39.6 weeks. But here is the critical point. London does not need to hit zero for the system to break. London needs to maintain a minimum operating inventory of approximately 200 to 250 million ounces to function as a trading hub, to settle contracts, to provide liquidity. When London drops below 250 million ounces, the market enters crisis mode. At current drainage rates, London hits 250 million ounces by early March 2026. That is 62 days from today. And when London hits that threshold, the entire Western silver market collapses because London is the physical hub. COMEX is the paper exchange. But when industrial buyers or ETF holders want to redeem for physical metal, where does it come from? London vaults. When COMEX contracts stand for delivery and the seller does not have inventory, where do they source it? London vaults. London is the emergency backup for the entire Western paper system, and that backup is being systematically drained to Shanghai. Now, let me show you why this drain is accelerating and why it cannot be stopped. The Shanghai premium is not driven by speculation. It is driven by actual Chinese industrial demand that has no alternative supply. China produces approximately 62% of the world's solar panels. Every solar panel requires silver paste for the electrical contacts. Chinese solar manufacturers need approximately 180 million ounces annually. China produces approximately 58% of the world's electric vehicle batteries. Every EV battery uses silver in the battery management system. Chinese EV manufacturers need approximately 45 million ounces annually. China produces approximately 71% of the world's consumer electronics. Every smartphone, every tablet, every laptop uses silver in circuit boards and connectors. Chinese electronics manufacturers need approximately 95 million ounces annually. Added up, Chinese industrial demand is approximately 320 million ounces annually. That is 26.7 million ounces per month. Where does China get this silver? Domestic Chinese mines produce approximately 110 million ounces annually. That covers only 34% of industrial demand. The remaining 210 million ounces must be imported. From where? Peru, Mexico, Australia, and refined in China, or imported as refined metal from London. But here is the problem. Chinese refineries are operating at maximum capacity. They cannot refine more than they are already processing. And mine production globally is not increasing. It is flat to declining. So Chinese buyers have only one option to secure the silver they need: bid higher than Western buyers, pay premiums that make arbitrage profitable, and drain the Western vaults. This is not a choice. This is survival. If Chinese manufacturers cannot get silver, their production lines shut down. If BYD cannot get silver for battery systems, they cannot make EVs. If Longi Solar cannot get silver paste, they cannot make panels. The cost of not having silver is infinitely higher than paying a $17 premium. So Chinese buyers will pay $92. They will pay $100. They will pay $120 if necessary. And every dollar they bid above the COMEX paper price creates more arbitrage profit, which incentivizes more traders to drain London faster. This is a self-reinforcing doom loop. Higher Chinese prices create arbitrage. Arbitrage drains Western vaults. Drained vaults create physical scarcity. Scarcity forces Chinese buyers to bid even higher. Higher bids create larger arbitrage. The cycle accelerates until Western vaults are empty, and we are watching it happen in real time. Now let me show you what the banks are doing about this and why their response is making everything worse. The Western bullion banks, JP Morgan, HSBC, Scotiabank, they see the drain happening. They see London inventory declining. They see the Shanghai premium widening, and they are panicking. Their response? Suppress the COMEX paper price to make the arbitrage less profitable. On December 27th, COMEX silver was trading at $79. The banks dumped 15,000 futures contracts into the market in a coordinated sell wave. The price dropped from $79 to $75 in 90 minutes. The banks thought this would discourage arbitrage traders. If the London price drops from $79 to $75 and Shanghai is at $92, the spread is $17. If they push London to $72, the spread becomes $20. Wait, that is the opposite of what they wanted. By suppressing the paper price, the banks made the arbitrage more profitable. They increased the incentive to drain London. They accelerated the very process they were trying to stop. This is the trap. The banks are short silver. They sold futures contracts and call options betting the price would stay low. Now they are trying to defend those short positions by pushing the paper price down. But every dollar they push it down increases the Shanghai premium and increases the arbitrage profit and increases the drainage rate. The banks are trapped in a paradox. To save their short positions, they suppress price. But suppressing price destroys the physical market faster. They are choosing short-term survival of their paper positions over long-term stability of the supply chain, and it will backfire catastrophically. Let me show you the timeline of when this breaks. From December 30th, 2025 to January 15th, 2026, current state, London at 991 million ounces. Shanghai premium at $17. Drainage rate 23 million ounces per week. Banks continue suppression. Paper price likely ranges $72 to $78. Physical price in Shanghai likely rises to $95 to $98 as Chinese New Year buying accelerates. From January 15th to February 15th, 2026, London inventory drops below 900 million ounces. Major industrial buyers in Europe and North America discover they cannot source metal from London at reasonable premiums. London dealers start quoting 8 to 12-week delivery delays. COMEX registered inventory drops below 40 million as some longs demand delivery. Paper price likely ranges $75 to $82. Shanghai price likely hits $102 to $108. From February 15th to March 15th, 2026, London inventory approaches 800 million ounces. The drainage becomes mainstream news. Bloomberg and Reuters run articles about East-West silver premium. Retail investors panic buy physical in the West. Dealers go sold out. COMEX margin requirements increase to slow speculative longs. Paper price likely ranges $80 to $95. Shanghai price likely hits $115 to $128. From March 15th to April 15th, 2026, London inventory drops below 750 million ounces. Major ETFs like SLV face redemption requests they cannot fulfill. Industrial buyers in the West start paying premiums above COMEX spot just to secure supply. Physical dealers in New York and London quote $98 to $105 for immediate delivery, while COMEX shows $88. The bifurcation is complete. Paper price likely ranges $85 to $102. Shanghai price likely hits $130 to $145. From April 15th to May 15th, 2026, London inventory approaches 250 million ounces, the critical threshold. LBMA emergency meeting. They announce revised allocation rules to prevent vault depletion. Exports to Asia restricted or heavily taxed. But it is too late. The metal is already gone. COMEX faces delivery failures. Emergency cash settlement imposed on some contracts. Paper price gaps from $95 to $135 overnight as the market reprices for physical scarcity. Shanghai price likely hits $150 to $165. From May 15th, 2026 onward, the paper market is dead. COMEX trading volume collapses as participants lose faith. Price discovery moves to Shanghai. Western buyers must pay Shanghai prices plus shipping to import metal back from China. The West has lost control of the silver market permanently. This is the roadmap. This is what the Shanghai Drain leads to, and we are currently in Phase 1 with 62 days until Phase 2 begins. Why does the COMEX not just raise the paper price to match Shanghai and stop the arbitrage? Because they cannot. If COMEX lets silver trade at $92 to match Shanghai, every short seller gets obliterated. JP Morgan alone is estimated to be short approximately 150 million ounces. At $92, they face billions in losses. They would need to buy 150 million ounces to close the shorts, but COMEX registered inventory is only 47 million ounces. They cannot cover. If they try to buy, the price goes to 110, then 130, then $150 as they chase limited supply. So the banks would rather suppress the paper price, maintain the Shanghai arbitrage, and slowly drain the vaults, hoping something changes. It will not. The Shanghai premium is the signal. It is the market screaming at you that the COMEX price is fake. When Chinese buyers with unlimited capital are paying $92 and Western paper shows $75, which price is real? The answer is obvious. Shanghai is paying $92 because that is what silver is actually worth in a supply-constrained world. COMEX is showing $75 because that is what the banks need it to be to survive another day. Eventually, the West runs out of metal to send east. And when that day comes, the Western price will not slowly rise to meet Shanghai. It will gap violently in a single session as decades of paper manipulation unwind in hours. If you are holding physical silver, your metal is worth $92, not $75. You own metal that China needs and will pay premium prices to acquire. If you are holding paper silver or ETFs, you are holding a claim on metal that is disappearing. Exit paper. Convert to physical. Now. The window is not weeks. It is days. The Shanghai Drain is not a theory. It is happening right now, today, December 30th, 2025. Chinese buyers are paying $92. London vaults are bleeding 23 million ounces per week. COMEX is suppressing prices to $75 and making the arbitrage more profitable. The banks are trapped. The timeline is set. And 62 days from now, when London inventory approaches critical levels, the Western silver market will face a reckoning that will rewrite the price permanently. The premium is the proof. The drain is the mechanism. The collapse is the destination. Hold your physical silver, watch the vaults. And prepare for the day when the COMEX price gaps from $75 to $140 because the physical metal is all in Shanghai and the West has nothing left to deliver. The Shanghai Drain is not coming, it is here. And the $75 price you see on your screen is the biggest lie in financial markets. Subscribe.